Good afternoon. Welcome to the evening video for TheoTrade. Good afternoon. Welcome to the evening video for TheoTrade. I am Blake Young. Today is April 20th, 2023, and today we're going to be discussing Tesla starts the pileup. Let's start before we get to Tesla and what that means for the broad market as well as the automobile industry. Let's talk about what move we saw in equities today. Now you can see the market is still open while I'm recording this, and we are selling off to close at the lows. This will be the first day that we're going to be closing near the lows in over a week. And reality is, if we close down, this will be the largest single net negative day going all the way back to March 22nd. Now, this sell-off doesn't mean that we are guaranteed to be watching a 5-10% correction all on its own. Yes, we're at previous resistance. Yes, we're at areas that the market sold off. Yes, we're seeing volatility at a multiple month low, and that pretends to set up an opportunity for a short or bearishness in equities. But we've been stuck, and we're still stuck in the same price action that we've had all the way back to the beginning of this month. So until we get through this low, this in and of itself is not enough to expect a big sell-off. But Tesla could be that catalyst. Tesla could have started this pilot. And it's not just Tesla running into the side barrier. This is Tesla impacting everybody else. Let's start by looking at Tesla and reminding you that Tesla accounts for a large percentage of the broad market. So when we see Tesla selling off 11% on the day, gapping down, closing down, not only is it a huge drop, it's a huge drop on expected earnings. Well, that doesn't seem to make a lot of sense. Well, it cleared the previous low and broke down and is pushing to the lowest close that we've seen going all the way back to January 22nd. As we're looking at that move, what does that really tell us? Well, Tesla makes up about 2.7% of the Nasdaq. So the sell-off of 11% is going to weigh down at least that 2.7% of the Nasdaq, but also pull other stocks similar to Tesla lower. Tesla is as much a tech stock as it is a automobile stock. As we're looking at the move, and we can say, well, what about the S&P? The S&P 500, Tesla is about 1.4%, so not as large, about half the size that it is in the Nasdaq, but still, it's the number 8 largest stock or equity in the S&P 500. So we're seeing all of these pull down and all of these influence the equities lower. We expect more impact with the tech sector because of the things that were talked about. If we look at the details in the earnings report and we're to dig into the comments made, well, like I said, they met expectation. Analysts expected to see 85 cents. They made 85 cents. You can see that the revenues did slip a little bit from 23.3 to 23.21. Now, that is not a decimal place. It is $120 million. So when we talk about net income, what they're making fell 24%. This is where it matters. It's not just the earnings per share meet expectations. It's not just revenue slipped a little bit. It's that the net income fell 24%. I've been talking about this in conjunction with the housing sector, with home builders. Home builders had a margin of anywhere from 9% to 18%, generally speaking, and those have slid down to 12 to 15%. Well, Tesla was at about 15% margins, and that had gone up, but now we're seeing that their net revenue, their net income, I should say, is down 24%. So they're sliding and their margins are getting smaller. In fact, they talked about the idea that the underutilization of a couple of factories, meaning high costs, and not producing a lot of vehicles is a problem. If we look at the revenues, as we're looking at the automobile sector, you can see it reached $19.96 billion, which is up. But again, if they're making more total but making less net, means their margins are drying up. Their costs have gone up, and they've been passing some of those costs on to consumers, and they're getting less vehicles sold, potentially. So as we're looking at these data, they said not only are we selling these cars now for less, we dropped prices last year, but we're going to continue to drop prices this year. Now, this is the exciting part or nervous part, whatever you want to approach it as. Assuming that Elon Musk has his thumb on the pulse of the economy and at least the demand for his vehicles and the impact of interest rates. You'll see in the earnings call, he commented that every time that the Fed raises rates, that's equivalent to an increase in the price of the car, which is true. And the uncertainty in the economy and the stormy weather for what he's calling at least a year, 12 months, that is going to feed into it further. So he says we're going to continue to lower the cost of our cars. We're going to push for higher volumes of our cars. So they're going to lower the cost, try to push higher volumes, which means they're going to make less net revenue. So even if they're selling more cars, yes, it may be a grab for market share, but they're going to be making less money per car. So even if they sell more cars, that doesn't mean that they're going to hit those numbers, that they're going to have higher net income. And I know that I commented that Tesla acts like a tech stock more than a vehicle stock, and at least in its valuations. But if you look, really what's driving it? 93%. 93% of its revenue is based off of automobile sales. And as we look at the margins again on Tesla, the net profit margin is 15%. If they're going to lower and cut their costs to get more sales, this net profit margin is going to drop. As we look at this, they're paying more and more in interest costs, as you can see there. And as we look down at the quick ratio, they're below 1, which means they might need to borrow to be able to meet their obligations. If we're going to sell cars for less and they have factories that are not being utilized properly and we see those things slowing down, then even if they pump up the utilization but they're going to make less money, this does not look good for the future for Tesla. Does that mean it's going to continue to feed in the market? Is this an indication or a determination of what we can expect from consumers? And I'm not calling for the collapse of Tesla. I'm calling for the idea that we could fall back down to 110, 100. But as we're looking at this, if the consumer is not confident, they're not going to buy new cars. They're certainly not going to be buying new cars and buying new cars even if they're discounted prices. If they can't afford it, if the interest rates have gone higher, they're not going to be buying it in Tesla. They're not going to be buying it in Toyota. Toyota gapped down and traded below 6-month lows here, or at least near 6-month lows today, off of Tesla's move. If you look at GM's only down 3.69%, but you can see a gap down back to support ahead of earnings. If they have similar earnings, meaning higher costs, as inflation impacts their bottom line, as inflation impacts their net margins, then we could see a miss in General Motors earnings as well, and we could be setting up for another 6-month low in General Motors. Taking a look at Ford. Ford also gapped down, closed down. Now we have a couple of extra days before earnings, but by the way, this is on the day before Fed Day. So Ford is already gapping down, following Tesla. Could we find Ford falling back down to $11? Could it fall down another full dollar down to $10.70? Well, if it follows Tesla, not only could you have this 3% down, we could finish off another 10% down just to find these previous lows, and that is ahead of finding out if the Fed's going to raise rates. If the higher interest rates are what is driving it, which is partly due to that, then the shorter term borrowing rates are also higher for consumers. As we see from the Treasury page, if we're looking at what Elon Musk said, he said every time the Fed raises rates, it is an increased cost for the vehicles. Now, yes, he is going to lower the cost of his vehicles. Understood. However, the cost of vehicles are also up, more so just because inflation is higher. Doesn't matter that used cars have pulled back. We're talking about new cars when it comes to Tesla, Toyota, GM, and Ford. As we're looking at the moves in those markets and we're looking at the expectations for future new car sales, not only are they higher cost because of the interest rates, they're higher cost because metal and plastic and chips and batteries and transportation and everything else and services have all gone higher in this inflationary environment. As we look at the prices and we look at the interest rates, remember, we don't borrow cars on a 30-year note. We don't borrow cars on a 7 or 10-year note, generally speaking. We are borrowing near the 5-year, sometimes the 3-year, And so as we're looking at these rates, whether we're talking about leases or long-term loans, we can add about 2% to this, which is 3 to 4% higher than the lowest interest rates that we've seen in cars. So instead of 2%, we're going to be borrowing at 5 and 6% for a new vehicle. And just as a quick side note, when you look at the 6-month and 1 year and compare that to the 10-year, we are still in one of the worst inverted yield curves than we've seen historically. And I don't want to be doom and gloom. I don't want to focus on only the negative, but these are opportunities more than they're doom and gloom. So we will look for consumer discretionary to break through its near-term support, maybe 143. And if it does, we are probably looking at an 8-point to 15-point move, which is going to take us from 5 to 10% lower. If we continue to connect to Tesla, then we ought to look at technology stocks like XLK, and we ought to look at the potential here. Let's clear off the charts. And this consolidation is even tighter. If we break through 146, we could be looking at another 5-point to 10-point move here. Maybe not a full 10%, but an 8%. And if we do drop to the last major support level, instead of just the last major resistance level, then we're going from 147 all the way down to 135, and that's getting us closer to that 10% correction. I think Tesla has already shown us the path. Tesla's already shown us the route. We're looking from 5 to 10% drop in equities, in technology, in cars, in consumer discretionary. Where do we expect to see things more stabilized? Probably the consumer staples. So consumer staples, as you can see, has bounced up, closed higher today, while everything else is selling off. Going and looking at utilities. Utilities down, but down 0.4% versus 3 to 4%. Last one we'll check is healthcare as far as the defensive sectors. And you can see down about 0.5%, while the rest of the market is down 3%. And I've used copper as my indication of true demand because the number one use for copper is housing. The number two use for copper is now cars, according to the U.S. Geological Survey, and the third is consumer electronics. Well, you can see that the demand has dropped 1.55%, which is huge drop for copper when there's no major economic announcements, and this is being driven likely because of Tesla. If Tesla's missing on its earnings, if Tesla's projecting lower demand and a need to cut costs, where do we think GM, Toyota, Ford, Honda, and other manufacturers are going to go? And those are an indication of consumer demand and an indication of consumer spending and an indication of the total economy and an indication of interest rates and inflation. So this is the first real sign of selling that we've seen in the last couple of weeks. I think this is the opportunity to start looking at more shorts, more collecting call premium on technology, consumer discretionary, while looking for selling put premium or looking to get into long-term positions with covered calls on consumer staples, utilities, and healthcare. That's going to do it for me today. Have a great day, everybody. Thanks for watching, and we'll talk to you again next week.